Usually drops about 10% about once a year. Edward Jones financial advisor Allison Gilman-Aquino here with balancing risk with the opportunities that corrections can create. It's not easy.
No, it certainly isn't, and no one ever said it was going to be easy,
right,
unfortunately.
Right.
That would be great, though.
Yeah.
But really, I think, Sean, all the recent market volatility has made a lot of people forget that the stock market is up about 80% from the lows set back in March of 2009. Thing is, you've got to be realistic. Corrections are part of the investing cycle. Now, 2009 and 2010 helped most of us bounce back from the recession of '08, but like Sean was just saying, no one promised it was going to be smooth sailing.
So let's look at this. If the Dow's at 11,500, a 10% correction means a loss of more than 1,100 points. So you say don't come unglued with that.
I mean, I know that that sounds significant,
right,
especially in light of what we've experienced in the past couple of years. But at Edward Jones, we don't think that's a reason for a code red alarm. It's not a reason to abandon your long-term approach to investing.
Now, 4 reasons here to be positive. First, we'll start with solid market gains.
We've seen those gains. Think about that 80% number in terms of just how far we've come since the recession ended.
And some economic growth.
Growth is sluggish, but it's there, so let's hope we see more of that to come.
Okay, another reason to be positive here, low interest rates, tamer inflation, that's helped.
Yep, we've got low interest rates, manageable inflation. The Federal Reserve pledged not to raise interest rates through the middle of 2013, keeping them at near zero levels.
And another reason to be positive, something to keep in mind here, let's not forget strong corporate America.
And I think that's gotten lost in the shuffle lately, Sean. Corporate America is strong and growing. Companies that weathered the recession came out lean and mean, and in many cases, they're paying rising dividends. Typically, a company's not going to do that if it's not forecasting good things to come in the future. Although, remember, companies can cut or even eliminate their dividends without giving you a heads up ahead of time.
You have a lot of people who would counter that, saying that's the kinder, gentler market of last week. What's ahead for this week? Who knows?
And that's when you wish you had a crystal ball that didn't fog up.
Because,
you know, who knows what's going to happen this week. It'll be interesting to see how the markets react to the president's speech today. But if you're nervous about the unknown, and a lot of people are, try to use this time to get your financial house in order. Get a portfolio review if you need one. Check to make sure you're putting enough money in your at-work plan to get the full company match, and keep your expectations reasonable. History tells us the stock market is unpredictable in the short run, and the path to making long-term gains can be bumpy. So if you focus on owning good quality investments that you feel comfortable with, owning them in both good times and bad, you're going to come out ahead, because one thing is certain, we are certainly going to see more of both if we plan on being long-term investors in the stock market, because what goes up comes down and back again.
And we'll see how the markets look later this morning with the president's speech talking when it comes to taxes. Allison, thank you very much. Don't forget, if you have any questions that you have to pass along, wake up 6 at fox6now.com. Rob?